Doyle is with Macquarie Group, where he serves as the North American economist and Canadian market strategist. So, David, we were talking earlier in the program about the fact that while we've seen a little pause today, stocks have really enjoyed this nice run-up in recent months. What's your assessment of where we are today?
Yeah, I mean, I think that stocks are telling you that things are getting better. Look, like, it doesn't mean that all the issues with the economy have been resolved, particularly the Canadian economy. But on the whole, we're moving from a phase where we had sort of an artificially imposed shutdown into one where there's growth ahead, and in fact, probably several years of growth ahead. Unless there's a material second wave that develops. And I think that that's usually an environment where stocks can do quite well. And sort of on top of that, you have a tremendous amount of both monetary and fiscal stimulus, lending support both to the economy and the market. So it's not all that bad of a backdrop for equities here.
Well, let's dive into the Canadian economy for a second to try to determine where that growth would come from, because there's been a few different talking points on the program this morning. On the one hand, there are concerns about building pipelines, and we've already seen, even though energy stocks have rallied off the lows, they're still down pretty strongly for the year overall. Patty Levitt-Reid was on earlier. She was mentioning that maybe some consumers are going to hold back on spending in areas that they've had to hold off on, travel or concerts, and maybe that spending doesn't come back. But then on the other hand, our top line story this morning was that, in the greater Toronto area, you're seeing home prices get back to record levels. So what's your assessment on where the economic growth in Canada is going to come from, David?
That, John, I think is a really good question. I think we've been in this period over the last couple of months where the growth numbers are going to look very, very strong in May and June. But in a lot of ways, that's artificial. That's just mechanical because you're moving out of the shutdown phase and into the reopening phase. I think as we move beyond, call it July, we're in for a much slower, much more grinding growth path in Canada. And a lot of that reflects is what I would call a lack of growth drivers. You mentioned real estate and energy in your comments. Those had really been the growth drivers for Canada from 2010 to 2020. Energy, it looks like it's struggling from here. And so all we're left with is real estate. And I think the real estate data has looked good over the last couple of months. I'm a little bit concerned about what it might look like in call it 6 or 9 months, when big banks might start, withdrawing their mortgage deferral programs. That might create more of a headwind for housing at that stage.
Something to watch for, no doubt. And in the interim, we continue to see a lot of spending. We had an interesting conversation earlier with Mike Novogratz, who, is making a huge bet on cryptocurrencies and gold, in part based on all the fiscal stimulus around the world. Tomorrow, obviously, we're going to be getting an update from the federal government on how much spending has been done so far. What would you be curious to hear from Finance Minister Bill Moore, when it comes to that fiscal snapshot update that we're going to get tomorrow?
I mean, if I had the chance to ask him questions, I would ask, what's the long-term plan, call it out 3, 4, 5 years, to bring that really extremely elevated deficit that we're likely to see in 2020 back to more normal levels? And what, I think also importantly, what are the growth assumptions that you're relying on to bring that deficit down? Because I found in the past that governments generally tend to, submit quite optimistic growth projections, and I think the long-term deficit picture could look very different if you put in a lower growth number. So I'd be curious about the details and assumptions behind the numbers that are presented.
We'll watch for those numbers. We got a jobs report coming at the end of the week, so there's going to be a lot to chew on. But just getting back to stocks, David, right now for the year overall, the TSX, as I mentioned, it's off about 8.5%. So given the fact that we have less of a weighting in this country towards tech, even with the rally in Shopify this year, just the math. The math means that we have underperformed the S&P 500, which is a lot closer to the flat line this morning than it was a few weeks ago, and the NASDAQ well into positive territory. What would be your outlook for Canadian stocks for the rest of the year?
I think it's really sector specific. I think in general, I would see the market as ending the year, a little bit higher than it is today. So from that perspective, I would lean slightly bullish. But I think it's really going to come down to the sectors. And, as we've talked about before, John, it's the sectors that have exposure beyond Canada's borders that have been doing well. And I would expect that theme to continue. So that sectors like tech, industrials, and you mentioned materials as well, if you're so inclined. So I would expect that divergence or dispersion within the TSX to continue through the end of the year. And I'd be continuing to emphasize and overweight those sectors that have exposure outside of Canada rather than ones like the financials that are more leveraged to the domestic Canadian economy.
And probably worth pointing out, I mean, you highlighted the key role that the energy sector has played in driving the Canadian economy. But if I'm trying to figure out, if we got Shopify as the most heavily weighted stock in the TSX today, if energy stocks don't carry the same weighting longer term because of the challenges that they've had in the past, I guess theoretically you could see some underperformance in the oil patch and still see a TSX that is gaining ground because you've got some of these other pockets that are growing in influence within the TSX. I mean, is that a fair assessment, David?
Yeah, I think that that's a very good point. And I think over the last, particularly over the last 5 or 6 years, you've seen a dramatic shift in the weights of the TSX, and it's been away from sectors like energy and materials, and towards what we would typically have called the other bucket 5 or 6 years ago. And the other bucket consists of sectors, particularly technology, but also industrials and consumer stocks. And they're starting to compose a higher weight of the TSX. So that potentially could lead to more favorable gains compared to what we've seen in the past, just from that composition shift, for sure.
Yeah, I'm just looking at it right now. I mean, the energy sector is about 12% of the index today. It was 20% 5 years ago. Hey, David, always good to get your perspective. Thanks very much. Appreciate it.
Anytime, John. Thanks for having me.
That's David Doyle of Macquarie Group, the North American economist and chief market strategist.